Hello everyone, welcome to today's US Open live webinar, Thursday, November the 24th. This is your host, Nikos Zabouras, Senior Market Specialist at FXCM. This is a webinar that takes place live twice a week, every Tuesday and Thursday at 14:20 GMTs, 10 minutes before the US markets open. Today, however, US markets will remain closed and they will close early on Friday due to the Thanksgiving holiday. However, we will talk about it more extensively later. Of course, markets today are focused on yesterday's Fed minutes, which they viewed, we would say, as dovish. But before we get into all of that, please read carefully the risk warning and the disclaimers, and then we will get the ball rolling. Once again, before we begin with today's commentary, please read carefully through the disclaimers and the risk warnings. Okay, so let's go ahead and get started. So since our previous session on Tuesday, what dominated the markets was the account of the last policy meeting from the US Fed, the US Central Bank. Markets viewed this as dovish, this event. The account showed that a substantial majority of participants believe that a moderation in the pace of rate hikes would likely soon be appropriate, as monetary policy, of course, approaches to a sufficiently restrictive level. On the other hand, policymakers judged that the pace of increases has become now less important, and they prefer to focus on the ultimate level of rates, which they now believe that is going to be somewhat higher than they previously expected. So there was a little bit of everything there. Of course, markets, as we said, viewed this as dovish, and they dumped the US dollar. And before this release, of course, we also had some poor PMIs from the United States, whereas Wall Street strengthened. Of course, as we said, today is a holiday for US markets, and tomorrow will be US markets will close earlier, which of course also affects a series of products, of FXCM products. So you can view more information about the holiday trading hours on your respective FXCM websites. Now, other than that, and as we look into Euro USD, we'll get into the technical outlook in a bit. But first, let's get a quick overview of the latest developments. Now, earlier on Wednesday, we had the Reserve Bank of New Zealand, which actually accelerated its rate hike cycle with a historic 75 basis points increase, which is in contrast with some of its counterparts, which have already slowed down the pace of hikes or are looking to do so. We also had the minutes from the European Central Banks out today. We can say that they really made headlines. European policymakers continue to be vague around the notions of the terminal rate and the neutral rate, but we have also seen there a consideration as to how they're going to proceed, given that they have already tightened policy very aggressively. They all seem to believe that more tightening is needed, but they're also contemplating a downshift, let's say, in the size of next hikes. Now let's go ahead and now take a look at the technical landscape. Of course, as we said, markets dumped the US dollar after the dovish, or at least the less hawkish minutes from the Fed yesterday. The pair started the day very well, but failed to set fresh highs, and it's a bit mixed, albeit in positive territory in the day. Now, on Tuesday, we had warned of a rejection of the previous highs, and we see this materializing today. It was here. However, the common currency is in the driver's seat, given the impressive month it's running, and it has the ability to test 1.05 with fresh highs, as we said, although it does not seem ready to challenge the next resistance at 1.0609. On the other hand, given the bull's inability to break above the previous high, there is some risk of a decline, although a significant reversal in sentiment would be required for moves below 10.194, which is the 38.2% Fibonacci from the November advance. And of course, as we have said, if we do close below this level, then bias would sit on the downside. But even in this case, we believe that the common currency is well positioned to defend the parity, in contrast with previous such efforts. Now, let's go ahead and move into USD JPY. Here we are. So the pair runs its worst month in 24 years, and even though it managed to rebound last week, it now faces renewed pressure. We can see this recent recovery effort, which was cut short, rejecting key technical levels. Now, given this short-lived recovery effort, now bears now push for fresh monthly lows. They're still just shy of such levels, but obviously there is a high risk for such an outcome. However, a catalyst will be probably needed for them to test the 200 days EMA, which we can see here in this region around 135, 134.80. Now, from a technical perspective, we can see that the relative strength index is close to oversold levels, and a reaction higher would make sense towards the 100 period EMA, and we're on an hourly chart, of course. It would be this region here, but we can say that it does inspire much confidence at this stage for a broader recovery that would challenge the previously mentioned key 38.2% Fibonacci, which also coincides with a trend down, downward trend line here at around 143. Now let's move on and go to the Kiwi, to the New Zealand dollar versus the US dollar. We said earlier about the policy decision by the Reserve Bank of New Zealand. Now, it delivered a record 75 basis points increase, and of course, it is one of the most hawkish central banks, if not the most hawkish major central bank out there. Not only it raised by that much, accelerating its pace, but it also expects further tightening ahead, and now forecasts the official cash rate to peak at 5.5% from 4.25% where it currently stands. Again, this is in contrast with other central banks. For instance, the Reserve Bank of Australia has already slowed down the pace of its hikes, whereas the Fed seems to be preparing for a downshift, and the ECB seems to also be considering such a scenario. Now, we also had the updated projections around the GDP, and the central bank now does see a recession, starting with a contraction of 0.5% in the June quarter of the next year. Now, this aggressive action by the RBNZ has helped NZD USD, which covers around half of its 2022 losses in its best month in 2 years. And it also heads for its 6th straight profitable week. Now, this has brought the 0.6452, 0.6469 resistance in its crosshairs. Sorry, but I can say that I'm convinced that the Q is ready to take this level out. Now, again, we look at the relative strength index, which shows overbought conditions. And we could see from here a slide perhaps back towards 0.6100. It would make sense, but then there is strong confluence of supports which could provide support to the pair if we see a further downward pressure, and it's this region that we highlight here at around 0.6960. And let's move now ahead and go to the SPX 500. As we said, Wall Street will not open today, and this affects the trading hours of many many FXCM products, the SPX 500 including, which of course is still pricing, but it will have its trading hours affected. Now, where do we stand on the SPX 500 technical outlook? It tries to set new highs. It's just a hair away from doing that. As we had talked from our previous session on Tuesday, and this has brought 4,120, 4,146 in its high side, this trend line here from the record highs. But sustained moves above this level may prove elusive in the near term, with of course the next major resistance located around 4,003 to 6. Now, there is still scope for selling pressure, but the downside remains well protected. We can see here that we have the upper border of the daily Ichimoku cloud, and right beneath it at around 3,890, we have a confluence of supports here with the 200 period EMA on a 4-hour chart and the ascending trend line from October's 2+ year lows. So that's pretty much it from the technical outlook. Now, again, we need to repeat that Wall Street is closed today and will close early tomorrow due to the Thanksgiving's holiday, which affects the trading hours of various FXCM products. Again, you can go to the FXCM websites to view more info around that. And of course, we need to watch out for the liquidity volatility conditions, given that the US traders are out and this creates thin trading conditions. Now, besides that, it's a light calendar, mostly Germany's Q3 GDP, which stands out tomorrow. While moving on to next week, it starts off a bit slowly in terms of economic releases, but things heat up later on. And USPC inflation is one of the key data we expect. However, we will talk more about that on our next session on Tuesday at 14:20 GMT. That's it from me. Thanks for joining me. We'll talk next week on Tuesday.